multi-location hybrid meeting of the Pensions Committee, which is open to the press and the public on request. The meeting will not be broadcast live, but as Geraint just said, we have just started recording, and that will be made available as soon as possible after the meeting has concluded. So we welcome the use of the Welsh language at meetings. I've had no requests for people to speak in Welsh today, so this meeting will be conducted in English only. Can all of us attending via Teams refrain from using the chat function and instead use the raised hand icon to indicate when you want to speak? And remember, as ever, to keep your microphone muted when you're not talking, and unlike Geraint, to make sure you put it on when you do start talking. So moving on to the agenda, we have agenda item number 1 is attendance and apologies, and back over to Geraint.
Put my mic on, Chair.
Thank you very much.
Got apologies from Councillor Simons.
Thank you very much. Now on this, I just have another bit of information which isn't on the agenda. Due to the disintegration last week of one of the larger of the 2 independent groups, which is now does not exist, Councillor Alan Slade, who was the nominee from the larger independent group, has come off the committee. So it means we now only have 5 members, all of which are from the Labour group. I think this is something we'll definitely need to revisit next year. But just in case anyone is wondering where Alan is, he's not coming again. So thanks very much. Item number 2, declarations of interest, and again back over to Geraint.
Thank you, Chair. I'll just read out the interests that I've got, and if members can just confirm whether they're correct, please. If I can start with Councillor Gordon, I've got that yourself, your wife, your stepdaughter, and your stepdaughter's partner are contributors, and also you've got a personal interest due to your work with Unison.
That's correct.
Thank you very much. Councillor Haller, I've got that you're a contributor.
That's correct.
Thank you. Councillor Williams, I've got that yourself and your wife are contributors, and yourself and your wife are in receipt of pensions.
Correct.
Thank you very much. And lastly, Chair, I've got that you're a contributor and that your father and 2 other family members are in receipt of pensions.
That is also correct.
Thank you all. That's everything, Chair.
Excellent. Thank you very much. Item number 3, we have the minutes of the Pensions Committee on the 3rd of October 2022. This item is for members to raise any issues and to agree the minutes rather. So first off, does anybody have any questions or queries off the back of the minutes as they're presented? If you do, put your little yellow hand up. I can't see any. So are we happy to agree those minutes? Yep. I'll take the silence as a yes. Thank you very much. Carl put his hand up. Right, fantastic. Right, moving on then, agenda item number 4. So we've had lots of meetings recently. We've got the minutes of the Pensions Committee from the 21st of November 2022. So if you remember, this is the special meeting we had about the annual report. So again, any questions or queries, anything anyone would like to raise? Take that as a no. Can people raise their hands or nod, or people happy with that? Thank you, Carl. David, fantastic. John, great. Thank you. They're agreed. Now, the next 2 items are for information only, although of a similar nature. So agenda item number 5 are the draft minutes of the Pension Board meeting of the 26th of the 10th, 2022. And then agenda item number 6, again for information only, are the draft minutes of the Pension Board meeting of the 9th of November 2022. And I'll take those together in case there are any questions or any points of clarification that anyone from the board would like to raise. Going through this quickly this morning. Fantastic. Thank you very much for that. Right, this is where it all goes wrong and we start to have a proper conversation. Agenda item number 7, the Wales Pension Partnership update. I'd like to hand over to Alex.
Thanks, Chair, and morning to everybody. This is a shorter quarterly update than perhaps you're used to in terms of previous meetings, and the main reason for that is that the meeting of the JGC, the Joint Governance Committee in September, was cancelled following the death of the Queen, and that fallen in the mourning period. So you'll notice that within this report today, there aren't a copy of the minutes from the JGC, just the operator update, which was an item that was scheduled to be presented, but obviously was cancelled. So as you recall, the JGC meets every quarter. They've got quite an extensive agenda, and actually there was a meeting just last Monday, I believe, which had quite a large agenda, given that there were 2 meetings essentially being rolled into one there. Just due to timings, we weren't able to reflect the update of that meeting into the pack for today, but you'll have that update as usually would be the case in March 23 at your next meeting. Probably just turning to page 42 of your papers. Been presenting this in this way for a couple of quarters now. Basically shows that as of the 30th of September, the 6 different sub funds that the Greater Gwent Fund is invested in. Just gives you a bit of a snapshot there of the valuations against each of those portfolios. I won't dwell too much on the movement of those values, because there's the next item covers investment performance in a lot more detail. I think probably just turning to the appendix in the report. So from page 43 of your papers, again, it's just a visual really of what you've just seen in the cover report. The pie charts show the proportions of each of the 8 funds across Wales, and you'll be able to sort of drill down to the Torfaen or the Greater Gwent allocations in there. This obviously runs on a time lag, so these are the June figures. December reporting would reflect on September, etc. So you're sort of running quite a bit behind now. I appreciate that. The page 46 also shows then that the monetary values. Again, it's kind of sort of the same information reported slightly differently. Pages 48 just give a bit of activity in terms of work that's been ongoing. There was a new investment manager added to the Global Opportunities. So that's an equity fund that this fund is invested in, the Greater Gwent Fund is invested in. That was successfully implemented, and I had a confirmation email just last week actually to say that had been reflected in the sub fund now. So that one has been dealt with. The second item on that list of activity is the Sustainable Equity Fund, and there's a detailed item in the agenda today, so I won't dwell on that one, given we'll cover it in more detail later on. The next couple of pages also cover the corporate update. Members will be aware that Link Fund Solutions, which is the sort of specific part of the Link business that the WPP contracts with, have been subject to takeover for a number of months. Previously, the Dye & Durham takeover looked to be fairly well advanced, but that appeared to have broken down based on some sort of overhanging legal queries really relating to the Neil Woodford Fund. So that I understand that is ongoing, this negotiation ongoing, but there's nothing substantial to bring to your attention during the meeting today. But just for awareness, you can also see that there's some replacement of sort of key personnel in the relationship we have, which I think from my perspective is welcomed, and are providing additional support to us. The rest is just really for information. It just evidences the sort of level of engagement that the host authority, Carmarthenshire, have with Link, and they also present to the JGC, and the chair will be aware that there was a detailed update last week. So that work's continuing, but I don't think there's anything substantial to bring to members' attention today. And so probably we'll just turn to the recommendations, Chair, unless there are any questions.
Okay, thank you, Alex. So before we do turn to the recommendations, do any members or indeed committee or board members have any questions or observations on the report that Alex has presented? Okie dokie. Then we move to, where are they? What page are the recommendations on? Oh, I've got them, Jeremy. Move to recommendations on page 61. Is that we note the investment performance that has taken place during Q3. So can people use the icon to vote in favour?
So, sorry, Chair, just to confirm, it's page 42 of the paper. So just noting the
I've moved on to the. Sorry, I've moved on to the following one. Right. This is the peril of not having you there to sort of dig me in the ribs. Okay, yeah, right. So here we go. Page 42 then, you said, Alex, yeah?
Yes.
So people, members happy to note the reports again by show of hands. Great, fantastic. Thank you very much. Moving on to the next one then, as I was keen to do, agenda item number 8.
Thanks, Chair. So this is the quarterly update on the investment performance of the fund's assets, and this runs again. It's sort of a time lag, but this is for the period 1st of July through to the 30th of September. Towards the end of this update, we will also reflect on the performance through the majority of what is now quarter 4. We're midway through the final month of this quarter as well, so we'll give a bit more of an update, and also just to support the item, I'll also invite Ethan just to comment on sort of the macro backdrop, and Betty, who's attended a lot of the individual manager meetings with Lewis and I through the quarter. So you can sort of see in the key messages, and I'm referring to page 53 of the papers, that the fund posted a very moderate negative return of minus 0.59% in the quarter. That did actually outperform the benchmark, which was minus 1%. So that's sort of positive from an active perspective. In cash terms, the fund did lose 21 million through the 3 months to a value of 3.483 billion. I think probably the point, there's a lot of content and a lot of detail within this report, and I'm more than happy that either myself or the advisors address any specific questions or concerns. I don't want to sort of take Ethan's points away in terms of the macro backdrop, but I think you can see sort of there's still quite a lot of volatility existing, and that the fund's investments are not immune from that. It's fair to say there have been pockets of strong performance, and I draw on the BlackRock low carbon passive fund that delivered nearly 4% positive return in the quarter. The fund's exposure to sort of emerging markets did underperform quite considerably, and that's sort of a theme that we've seen this year. And members will recall that that particular mandate did have quite a large exposure to, I say a large exposure, it was a small exposure, but it was the largest that the fund had to Russia at that time. And I think the ripple effects of that has caused some challenges there. So you can sort of see that the range in paragraph 3.3 on page 53. We've also gone through a very turbulent period with the mini budget and the fallout from that in terms of the impact on what we would consider traditionally lower risk or less volatile fixed income assets. Fortunately for the fund, we've got global exposure to government bonds, government debt, and that only takes a small proportion of that is directly related to the UK, so we're sort of sheltered from some of that to a degree. Some of the fund's other assets are sort of, I think, largely achieving what we would expect in terms of diversification, a degree of lower volatility, and helping to shelter some of the real negative returns that we're seeing in the market. Probably, as I always like to do, really is to remain long term in terms of focus and outlook. And I think there's a chart on page 59 of the papers which shows longer term performance of the fund versus the strategic benchmark that it's measured against. And as you can see, the sort of the left hand side of that chart does show largely what we've reported on all year, with volatility and some quite significant negative returns. But if you look to the right hand side from a 3-year basis onwards, 3, 5, 10 years and since inception, we're still positive returns and ahead of the benchmark across all of those time horizons, which I think it's important context to keep that in mind, given that we are long-term investors funding long-term liabilities. Probably the final point before I just pause for any questions or inviting our advisors is just to take you back to page 58. 58 provides a snapshot of the fund's valuation as at the 30th of September. Just as a reminder, that the left-hand column sets out all of the various investment mandates that the fund has investment in. The bid price or the market value of those investments in the second column from the left is essentially the market value as of the 30th of September. And then the two columns to the right-hand side are the allocations in percentage terms, with the obviously asset allocation is the actual allocation, so that's the percentage of mandate relative to the fund, with the final one being the sort of strategic allocation, and that is essentially what was agreed by the former pensions committee at the last investment strategy review. So what you'll notice is that in the majority of cases, we're broadly aligned there between the asset allocation and the strategic allocation, but there are some notable outliers which we believe we're monitoring closely, but we do need to take some action to address those. There's actually an item on the agenda later today that I believe will take the first real material strides to address in that, but there will be more work required. And I think that we will need to conduct an investment strategy review in the new year. So some of these figures may change, but I think it's just important as a reference point for you to just be aware of where the fund is positioned there relative to the long-term strategy. I think at that point, Chair, I'll just pause in case there are any questions or any comments, and then maybe I'll invite Ethan just to comment on the market and give a bit more of an update in terms of what's gone on more recently.
Yeah, of course. So before Ethan comes in, does anyone have any questions specifically on what Alex has just outlined? No, we're cracking through it this morning. In which case, Ethan, thank you very much for joining us. I hate to think what time in the morning it is, but over to you.
I have two phones, two clocks. Sometimes I go by one, sometimes I go by the other, so it's fine. Anyway, great to be here. I'm going to talk a little bit about the macro backdrop of the last quarter, but really, obviously, a lot of it has been well telegraphed, particularly in the UK, since the UK was the unlikely star of the global show for the third quarter. My mother's also a politician, I think I mentioned, for 35 years, and she used to always say to me, if there's only one thing worse than being talked about, it's not being talked about. But I'm not sure if that occurs on the global stage, because the UK was talked about, and it's sort of a little bit too prominent, perhaps, for most of our liking. So what do we learn from the third quarter and the UK's starring performance? It is that markets have very little tolerance for when fiscal policy does not square with monetary policy. So a mini budget of tax cuts did not square with the restrictive monetary policy the Bank of England was trying to pursue, and markets voted very radically with their feet and had a vote of no confidence. So that was interesting as a petri dish for what might occur around the world. The other interesting political adage I bring up this quarter was the phrase, a week is a long time in politics, because it certainly is a long time in markets too. Over the course of 1 week, we saw swift disintegration of confidence, particularly in UK gilts, major sell-offs, moves that had not been seen previously for decades, and the basically bringing to the brink of a number of UK defined benefit plans who had significant exposure to gilts, most of it with borrowed money. So that, of course, precipitated the Bank of England intervening at the end of September in a very kind of a swift, unprecedented move to calm markets. And really since then, of course, that triggered the change of government. We've seen relative calm. We've also seen relative return of strength to the currency, as it has returned almost to levels that it was at, around 1.21, 1.20. Haven't looked this morning yet, but it certainly has recovered significantly from its dip in the third quarter. So a lot of that's relevant because even though this was a crisis like no other, it did not feature the major banks. It was really critically around the defined benefit plans and some of the LDI managers. It was a sign that we have learned some lessons from 2008, in that we've learned about the importance of speedy reaction from government bodies. And that was actually exemplary in terms of how they reacted. We've also learned that, as I said, that the markets are quite fickle and won't tolerate much in terms of incoherent policies. And that's an important thing to watch going forward. But certainly now we are under the thing that no news is good news, and that we've had little news in terms of the UK economic development. I know Betty will address this later, but this was also relevant for your portfolio, because obviously a weaker sterling, while it's bad for the country and bad for inflation long term, it can be good for a globally diversified portfolio, and that you will enjoy the benefit of those the appreciating dollar and euro relative to sterling in your global investments. So that is also interesting. The other important point to just stress here is that we're in a climate where good news is bad news and bad news is good news. And that may seem a little counterintuitive, but what that means essentially is typical indicators that we normally look at as positive, such as lower than average unemployment and strong job growth or strong wage pressure. That is actually interpreted by the market as bad news, because it's an indication that inflation will remain and that we will have to have rising rates for longer and more restrictive economic policy. It's important to stress that we have had an extraordinary trajectory of rate rises. We have had 8 consecutive rate rises by the Bank of England, 6 by the Fed. The last 4 by the Fed were 75 basis points. And in the past, a 25 basis point or 50 basis point raise would have triggered an entire market meltdown. Now, 75 basis points seems to just be normalized. Similarly, 8 consecutive rate rises in the UK, the last 75 basis points by the Bank of England, which had not been seen since the 1980s, even that has become normalized. But what now we're all focused on is the central bank divergence and who's going to be the first to blink or to pivot. And the Bank of England's indicated that because of mortgage rates being so high, they may have to stall or be mindful of that. And I'm sure you know that from your constituents, the dramatic impact on fixed rates coming off, which all of which come off every couple of years, 3 years for people on these mortgages. The US mortgage rates tend to be locked for 30 years. So there doesn't tend to be that same visceral impact of higher rates, but I know that they're going to be visceral here in the UK. So that's one thing to just bear in mind in terms of how the UK Bank of England is likely to react. And then, of course, the Fed is talking about decelerating, so perhaps moving at a slower pace, and that has triggered positive reactions in markets. So we've seen some comeback in markets over recent months, weeks, as they've seen an indication that the Fed will slow down its rate rises, but they're still going up. Inflation remains a concern. It's hit 10% in the UK in September. It's clearly driven by energy to a degree, even though that's not really the driver in the US. The US driver seems to be demand, labor, but also commodity prices are coming down. The oil price we saw into the 70s again. Food prices back to where they were pre-Ukraine. So that's all the indication that that's perhaps likely to subside. So you'll see the evidence in your portfolio. It's been a difficult year for bonds. It's been a difficult year for equities. It's been a better year for global equities, given that they're coming back in different currency, and that's given you a bit of a boost. The last thing I wanted to mention was just, well, 2 matters actually. One was, obviously, you were not among those defined benefit plans that were making headlines in September, primarily because we don't use LDI, leverage-driven investments. We don't employ leverage. However, their fallout will be relevant to you because they will now, I work with a plan who has suffered with that, and they have now a swollen, disproportionate private asset allocation. Their private assets are far larger than they should be. So you will perhaps see some funds no longer investing in private equity, infrastructure, private credit, and that's damaging to them, but it could mean that there's less competition for you, more opportunity for you. That all bodes well. It's also those funds with these private assets, as you're starting to build, that have performed better over the course of this year because those assets are not marked monthly or daily, and you have a bit of a chance to smooth volatility and just diversify returns. The final point is around emerging markets. I think it's just important to stress how our thinking has evolved on emerging markets over the course of the last year. It's hard to believe, but a year ago, Russia had not invaded Ukraine. We still did not have that as a major geopolitical flashpoint. Now that we have, that is clearly creating a new paradigm in emerging markets thinking, which is that certain countries could be deemed untouchable, uninvestable for various reasons, moral, political, a wide range. And China is kind of sitting on the edge of perhaps having that classification. Partly the political change there, the consolidation of power, the suggestion that there is very little transparency at all now. There's a chart in the papers showing that. It's very hard to know what to believe coming out of China in terms of growth numbers. And even though a few weeks ago it seemed like they were committed to zero COVID, now they seem to be rolling that back. It's not clear that they are as committed to their economic growth story as before, which was really the basis for why China was a good investment case. So I'd say that what we will be doing over the course of the next few weeks is re-underwriting the case for China and emerging markets, rethinking that as valid in your case, your portfolio. Does it have the growth there? Does it have the and the promise that previously we've had, has the geopolitical risk risen? So that will be, it's a small allocation for you, but I'd say in our discussion with Russell, we will be, just re-underwriting. Doesn't mean we'll change a view, but it's kind of retesting the view, which is fairly important. So finally, the last geopolitical thing to point out is around the US elections. Clearly, that was a bit of an upset for the Republican Party, not because they didn't get the result they expected in terms of a massive change in the midterms. That bodes well for stability and for the idea that legislative change can still happen with the Democrats holding the Senate. It won't always be easy, but at least there's a better chance than having everything blocked. So that bodes well for some stability there in terms of getting change through and navigating through this soft-ish landing. Recession is the final thing to talk about. Clearly, that's on everyone's lips. What I'm focused on is what kind of recession this is likely to be. While employment remains robust, I don't believe this will be a deep, protracted recession, primarily because the most visceral connection to consumer sentiment and behavior is whether they can get a job or have a job and whether they can keep a job. And while that remains strong, as it does in the UK as well as globally, I don't think that will affect the consumer to the same degree. So clearly something to watch, but we are on top of that. And then just as far as the last few points, I mean, clearly tech and Bitcoin and FTX implosion has all been in the headlines. You obviously have no exposure to any Bitcoin or any kind of digital asset. You are exposed to tech. That's a key part of many portfolios. Been quite a lot of contamination there. Your portfolios are well balanced though between growth and value, so that gives it an important edge. I'd say, given that you think about asset allocation here at this committee, I want to leave you with one acronym which you may know well. It's been a bit kind of cliched now after a few weeks, but it's on just page 71, the top there. Previously, it used to be that equities were the only place you could be in order to drive returns. And now with bond yields where they are, so it used to be called TINA, there is no alternative to equities. Now the phrase we're seeing is TARA. So there are reasonable alternatives in that now when we look at, say, investing across our asset allocation, bonds and equities, bonds look attractive. Even cash looks attractive when it can make, if the base rate is 3%. So that is important because some of the alternatives that have come around recently have been priced at a level that used to be attractive relative to bonds, but no longer are. I will rather take a yield of 3% in a bond any day over a 3% yield in an infrastructure investment that is for 15 years and has a lot of risk involved. So we will have to now hold everything to a higher standard, a higher threshold in many ways. And that's just part of the underwriting process that we'll have to think about. So continuing, now that we're looking at this winter, we're in the middle, obviously you're feeling it today. Clearly the winter is going to only kind of sharpen the focus on energy security, so-called energy terrorism going on in the Russia-Ukraine region. That's going to be really important to watch over the course of the winter and also into next winter, as my understanding is that it's 2023 that the gas supplies are really under pressure, that there has been enough locked in for this year. And clearly continuing to watch the other areas. The FTX debacle underscores that governance is still not where it needs to be. We are still relying on piggybacking on other kinds of, there was the last phrase on Twitter, somebody had posted about where was the due diligence with respect to FTX, but they had a typo and they put where was the dude diligence, D-U-D-E. And that to me just summed it up. This was exactly what it was. It wasn't due diligence, it was dude diligence. It was this person this dude that dude likes and this other dude decided. So very little due diligence at all. And that is really what we're wrestling with, serious lack of controls. And it's very disconcerting that that's still happening, but we need to be mindful of that. So happy to take any questions. I hope this wasn't too long as a summary, but there has been quite a lot packed into one quarter.
Now, if anything, I'd like to have listened for much longer, so don't apologise for being too long. No, I've got some questions actually, but I'll happily take questions from the meeting first. So I've got David's got his hand up. I'll take David first, and if anyone else has anything, I'll take them sequentially. David.
Thank you for that, Chair, and thank you for that update. Very interesting. I guess a couple of little points for me. Firstly, from what you described, this was a particular period of volatility in September with the UK impact. So would the expectation be that that recovery that you mentioned continue or consolidate? That's the first one. Second thing, when you describe emerging markets, you referred, I think, to investments in China as a part of that. It would be helpful to get some feel for what was meant by emerging markets. And then finally, is there any predictor in terms of what's happening around increased wage demands that are happening in this country and potentially in Europe as well, and that impact on inflation and how that may impact?
Yes, excellent points. As far as the UK, that is the kind of the million-dollar question, of course, is where from here does sterling go, and where does the recovery? I mean, there are a number of significant economic stresses, I suppose, on the UK, given its the debt levels that have been accrued really since COVID, the need to the Brexit aftermath that is working its way out. We saw that one of the direct effects of Brexit has been this really the lack of some sort of foreign demand for things like UK gilts. The fact that the UK pension industry really dominates as holders there, which makes it a somewhat illiquid and unsustainable market, really, as far as others to invest in. So that's prone for more volatility, we would say. As far as where the currency is going to settle, very difficult to say. I mean, clearly it's kind of creeping upwards now. It's 130 has been kind of a base level in the past. Now it's around 120, or it's north of 120. So, but equally, we have to kind of have the countervailing forces there, and the fact that inflation is really is high here, and then we have this strain of the mortgage levels, whether the Bank of England will be stopped out essentially, and where it can go with rates, because it just cannot put that pressure. And you've seen on the consumer, you can see that the bank knows that. And it basically said at the last statement, we're not going to be driven by financial markets and expectations. We are going to set it where we think the country can bear. So if the country can't raise rates to the same degree, there's a chance it won't keep inflation in check. But I'm not as worried about that, because I don't think it's demand-driven inflation here anyway. Inflation can only really affect demand, and it's actually more supply-driven. The energy price imported inflation, so I'm not as concerned. But a lot of uncertainty, and I'd say that for us the key thing is, where does sterling settle? Because if sterling continues to get stronger, we might want to think about whether we want to put more assets into sterling, less into dollars, and not continue to see that loss. But we'll be continuing to monitor that. Emerging markets, China is about 40% of emerging markets. China, Hong Kong, and Taiwan would probably be somewhat north of that. But it's a significant part of emerging markets, probably the dominant part of emerging markets today as a single country. But it also includes numerous other countries, such as a significant portion of Latin America, which is less liquid. And certain parts, I say South Africa would be in there, and used to be there. Certain parts of Eastern Europe were in there, but definitely Asia was the dominant segment of emerging markets, and China dominant within that. So we look to the indices as a kind of guide. China's still part of the index, so most emerging markets have to stay in some way managed close to the index. So the issue, and we are going back to them time and time again and asking, what's the story? Do you still believe this? Russia used to be about 8%, and that's now been taken out completely. So there's been a bit of a shuffle in emerging markets, and the question is, what's the thesis? And it's sometimes difficult to ask an emerging market manager, because that's their whole livelihood, is investing in emerging market. So they're always going to think about it as positive. I will say the word on the street right now is that China is the trade for 23 by China, because it's been so kind of underwater. But I think there are a lot of significant concerns about China, as I mentioned in there. So definitely not more. Now, I apologize. I wrote it down and I forgot the third question. So I apologize. I didn't write it down. I was just so keen to jump in. Could you just remind me of the third question?
Sorry, it was just saying that, whether you see this sort of a continued impact of increased wage demands, etc., on inflation.
Sorry about that. Yes. So yeah, that's clearly the focus of the Fed right now, is stickiness, service level, and inflation-driven, wage-driven inflation, because that's considered to be more sticky. Most part, I see that wage demand is going to be lumpy, and wage change will be lumpy. Often these changes are kind of overdue by the time they happen. and then they do happen in one jump, like I'm seeing 10% COLA or cost of living adjustments across, say, public pensions right now. That's clearly probably the peak that's been seen for many years. But as to whether that will continue, I don't expect that to continue at the same level. There will be that jump that was needed to equalize and then not continue, simply because there just isn't the same demand pressure right now. We're seeing a lot of tech layoffs, significant tech layoffs. Some, say, for example, now moving into the old economy. And that usually that's not necessarily affecting the lower earning worker, because there's still a lot of demand for lower earners. But it just takes that kind of the I suppose the negotiation ability, the leverage away from the worker when there's a kind of a backdrop of softness. So I see it having one lumpy increase and then flattening out.
Okay, thank you, Ethan. Does anybody else have a question for Ethan specifically? In which case, I'll ask mine. I'll start off with an observation that presumably then what you're saying is the world can sort of heave a sigh of relief that we didn't get a double sucker punch of Truss and then the return of Make America Great Again in November last year, because that really would have scared the horses and everybody else. Two questions, one of which is quite Mickey Mouse. As we actually did better against the benchmark in Q3, am I right in thinking that's because of the substantial holdings we have in outside sterling, and that's part of the reason why that held up better than it would have done otherwise, or was there no causal link between that?
I can take that. There is the benchmarks. If you have a sterling portfolio, then the benchmarks in sterling. There is not a difference between the benchmark and your currency. Okay. I do think that you can have some variability, for example, in this low carbon thing, which is about what, 22 or 25% of the portfolio right now. You can actually have quite a bit of variation in that based on, basically where oil is this quarter, because the quarters where oil is weak, or, if it's kind of retreating, it tends to outperform in quarters where oil is strong and you basically don't have very much exposure to fossil fuels. You will underperform. It's almost fairly predictable. But if you have a longer term thesis that, we have to move to more of a net zero, and you just don't want to have the same exposure to fossil fuels as, a vanilla kind of index, then, you have to kind of look through the, volatility or the under one quarter, over one quarter, that kind of near term stuff, and say that longer term, it's the better bet to make. So I think that may have had because it's such a big allocation, that alone can drive a lot.
Fine, okay. And the next question then, and this comes back to your point, this is definitely for you, Ethan, about your point about the dues diligence or lack thereof. And obviously, the back end of last week, Jeremy Hunt announced that he wants almost another big bang in financial regulation over here. Might that have some side effects on what you're talking about in lax diligence as it is, and potentially things going a bit haywire?
Yes, well, I just want to step into another regulatory situation, which is TPR regulating the pensions. I've been focusing a lot on that and the defined benefit pensions, the corporate, because it was really the three bad actors of Tata, BHS, and some other Maxwell. There one or two bad actors in defined benefit pensions, delinquent contributions, triggers a wave of overreaching regulation, which ultimately led close to ruin. In that there was an atmosphere of distrust and an atmosphere of, needing to kind of fooling yourself into thinking you can take out all risk in a pension around interest rate and inflation, and ultimately, doing the opposite, charging it up with high risk and leverage. So that's just a caution about how regulation tends to overshoot on the basis of one or two bad actors, and it can be quite damaging to an industry. We're only seeing the fallout of that now. So whether there's an overshooting regulation again in the case of Bitcoin and digital assets, that's very likely. Unfortunately, that's a mistake we keep making. Arguably, we also did it after the financial crisis in 2008. We over-regulated some financial institutions. So yeah, I think that could help in terms of we will always fight the last war. Yeah. We will never be able to keep up with the innovation, change, etc. And I think one of the key lessons from this digital assets is none of my clients invested because it was too complex. Sometimes I felt stupid saying that. I felt like I don't understand it, so I genuinely can't recommend it. But most people will not admit to not understanding it, and they will kind of go nonetheless. So I think that is a problem with digital assets. They're so complex, and there'll be another complex thing that starts up later. But I hope that there is another review. And the problem with this, and this came up with the defined benefit thing too, is the more examples there are of, say, trustees or board members missing stuff like this, the harder it is to find good people to do that, because there's just too much liability attached to it. So, these are generally not professional trustees. They're coming in to do the work, and unfortunately, complex decisions are being made in their forum, and they don't get a chance to they don't put up their hand and object, and then it looks like liability hangs for them. So I think you're right. There will be. The other thing that's important to say is there's certain digital asset trends that are not bad necessarily, but for example, around, say, sovereign currency and blockchain as a manner of kind of a ledger for certain transactions, which will be an important change. So we shouldn't throw the baby out with the bathwater when it comes to digital assets, but certainly these cryptocurrencies and these coins, I didn't really understand them, and it seems like I was right.
Yeah, well, that
Actually,
makes at least two of us. Yeah, Betty.
Can I just sort of say, I would actually argue that the regulation in respect of Bitcoin and digital assets has worked actually quite well. Because I think if you remember, say, over the past year, there's been all this stuff about the FCA saying that, because there's no way of doing know your customer and all these checks and anti-money laundering, anti-terrorism, that basically if you can't have the same standard of that as you have in your regulated, UK institution, you can't have your money going in. And that basically it stopped the banks from allowing money to flow between, say, a high street bank and a digital platform. And that's why they're all in Bermuda and places like that. So I think what actually happened is because they were so opaque and because it was such an obvious, a inconsistency in terms of the way the banks and financial institutions here were regulated, particularly with know your customer and all that kind of stuff, it kept all this stuff outside of mainstream finance. And so it hasn't actually been transmitted to the broader financial system and pension funds and institutional investors. And so, yeah, this is, meme stocks and high profile. And like what you were saying, Ethan, earlier about people talking about you, but this is a small minority of people. And, and it's all very colorful. And you've got these flamboyant people who had on paper, a lot of net worth, but, do we know anybody who's lost any money other than maybe somebody's kids who were punting and should have known, and this would teach them a lesson? So I would actually argue that by holding to the existing standards, we actually saved ourselves from having this kind of, corrupt the broader mainstream financial world.
Okay, thank you very much. So anybody else have any questions specifically for Ethan? Then presumably Alex is better. You coming in now, or Alex, is it back to you?
I mean, yeah. In the interest of time and share with the three sort of large updates in the exempt session, I'm happy, and if members got any questions, we can address them now. Otherwise, perhaps we can move on. I think the final point from me, just to provide a little bit of reassurance, is that Q4 has definitely been a better period. That some of that's come through in the updates, and I'm sure you'll get more of it in the March meeting. But in terms of just putting some numbers behind that, the value of the fund increased about 24 million on the September value. So in October we were up to around 3.5 billion. There was quite a significant jump through the November period of about 163 million. So the fund at the end of November was around 3.7 billion. And members may recall from prior discussions that we topped out in December 21 at 3.9 billion, sort of the record highs we'd achieved. So we're a couple of 100 million shy of where we were really at the start of this calendar year. And I just wanted to provide that perspective that although there has been a lot of noise and a lot of turbulence in the markets, I think the diversified approach has meant that we've been contained within a lot of that, and hopefully for a better 2023.
I like the way you're hiding your light under a bushel. Obviously, it's all to do with your excellent stewardship of the various funds. I think you need to be a bit less backward in coming forward. Right, okay, before I start gushing, let's move on then. Item number 9 is the Responsible Investment Working Group update. And Alex, back over to you again. Thanks
very much. Again, this is sort of at the request of the chair, I suppose. I'm the chair of the IWG and the board, Ian Coleman. I think we've put together this update basically just to present to the committee the quite a extensive amount of work that's going on in the responsible investment space, and this is obviously complementary towards what the WPP are also doing. So I think there's not too much to draw attention to specifically, other than point 1 in the report on page 97, and this is that when the Responsible Investor Working Group was established back in sort of 2017. There was a terms of reference established then, which basically set out the roles and responsibilities. I think what was recognised earlier this year is that with new membership of this group, and the fact that the responsible investment agenda has moved on quite considerably since that time, that it would be pertinent to review the terms of reference and just revise them really to reflect what the group is now sort of working on as a sort of subgroup of the committee, and just point to reiterate that group has no decision-making authority. It's really just sort of a sounding board and a recommendation into officers or things that can be put through to the pensions committee. So in a second, I'll turn to that appendix, because we're essentially asking the committee just to approve the revised terms of reference and invite any comments. I think just touching briefly on some of the other items that were considered at the meeting that we had in November. The Active Sustainable Equity Subfund, which is, as I said earlier on, the WPP's latest equity offering. All members were invited to the training session that was delivered by Russell Investments, and I know many attended, so thanks again for your time there. That clearly was an important engagement piece before we got to the stage of considering this subfund for investment. Probably one of the more detailed areas that we've been focusing on as a group is local investing, and this is very much aligned to the levelling up agenda of government, and thinking about how we can use the assets available or the capital available within the fund to invest in local opportunities. And local is broadly defined as UK-wide, but clearly there's an ambition to look at things more closely to home in terms of Wales or even within Gwent, if at all possible. I think really what's been recognised through discussion is that there isn't really a policy in place around some of this stuff at this stage, and I think probably to assist with officers and for members' benefit is to probably over time we need to try and develop some policy objectives that sort of give a framework around what we can and can't look at for investment. And I think the role of officers through both our local advisors as well, but also working with the WPP, will be to establish or identify those investment opportunities that then meet the policy objectives. So that's sort of an early stage report, if you like, and I think the view of the group was that this would be on the agenda for the coming quarters as we develop something alongside the investment strategy review, which we've also referred to. Project Zero is a draft, it's sort of an investment opportunity which is for consideration later on the agenda, but given the merits of it from a responsible investment or an ESG standpoint, we thought it was useful for the group to have basically a review of the draft proposal in place, and for any comments and sort of seek some engagement from that point of view. So I think that was positive, and I think largely helped the progress that's been made on that to date. The final two items really are sort of standing quarterly items that have been on the agenda of the IWG for a number of years. There's a responsible investment subgroup of officers and advisors within the pool, and the Great Gwent Fund is represented by myself and Lewis Gray. And so there was a number of sort of developments in that space that we thought were useful to bring forward for the group's information, not least the recent submission of the second iteration of the UK Stewardship Code report. Hopefully members will recall that the WPP became a signatory to that UK Stewardship Code in 2021, and part of the requirement is that you produce a report on an annual basis to be able to continue and maintain that signatory status. So it's useful that some of that is coming through, I think, in the group's agenda. And the final point is just the LAPFF. The fund is a member of the LAPFF, and they produce on behalf of their membership, which is the majority of the LGPS, a quarterly engagement report which captures a lot of the work that they're doing, and that's largely a full information document. I'm not sure if it's worth pausing there, Chair, in case there are any questions on any of the detail before perhaps we just look at the terms of reference briefly.
Yeah, that makes perfect sense. I think before I ask any questions, I can see obviously both Ian and David were at the meeting. Are there any reflections that either of you would like to share with the rest of the group? So Ian first.
Yeah, I'm happy with the report. Yeah, I've nothing to add. I'm happy with the report. I think we're making good progress.
Excellent. David?
No, I think, sorry. So, no, I think clear and accurate. And yes, I think it's fair to say that we did go through the terms of reference fairly thoroughly, and emphasise the kind of reporting nature of this group to the committee in terms of giving advice, support, recommendations, but not decision making.
Correct. So to the wider group now, does anybody have any questions on what Alex has outlined or from the paper that's been presented? In which case, Alex, I'd just like to say, I think what was really encouraging going to the second meeting, I mean, from a personal point of view, was just how much of the info had sunk in in the intervening 3 months from sort of starting in May and having the first meeting in June or July. And just to say, to agree with what David and Ian have alluded to, we did have a very good conversation where really we sort of went around the territory in a lot of detail. And in particular, some of the questions about the impact investing, looking ahead to what will have to be quite a big piece of work after Christmas, looking at the investment strategy for the next 3 years. I think, yeah, like I said, it's really encouraging piece of work, and I think we can definitely use that forum to test to destruction some of the issues we're going to have to, I think, overcome with increasing frequency as the next couple of years come upon us. So Alex, back to you if you want to talk through the terms of reference.
Sure.
In detail.
Thanks, Chair. So page 101 of your papers. As I say, this is largely this is the final version that's been agreed amongst the IWG. It was originally presented in July. There were some comments that as officers we took that away and revised, and then it was again commented on and agreed at the meeting that was held in November. So we're comfortable that this has been looked at in sufficient detail. I think the key points that I would just draw out of the document is that clearly the IWG does not have a decision-making role. And its responsibility also doesn't extend beyond RI matters. I think that was something the group were conscious that they didn't want to sort of be interpreted in that way. So hopefully that's clear. The other thing is that we would always call on and take the necessary advice. And I think an example was the November meeting we had. Betty joined, but also we had Russell Investments present a particular investment sub-fund. So that's an example whereby we're drawing on the expertise in these areas that can really help inform and educate all of us as we progress with sort of decisions eventually that come through the committee. That the group has got membership of the board and the committee. It's not sort of constrained, and we'd encourage other members to join if they've got an interest here. But critically, I think from an officer perspective, we do capture the views of the chair of both the committee and the board, which I think is important. Probably that's it in terms of the key points I wanted to draw out of the document. Hopefully the roles and responsibilities are fairly self-explanatory, but I'd be grateful if members can approve the document, but any final comments, we'd be happy to take them.
Okay then, so again, if anybody has any final comments, can you raise your hand on through Teams? If not, then the recommendation as it stands is at the top of page 98. So the recommendations are that we note the contents of the update and that we approve the revised terms of reference. It's definitely something which I would want to endorse. So if members could show if they're happy with it, Carl and me, presumably John, right? He's still there, right? There you got 4 out of 4. Then fantastic. We can rule the world. Thank you, committee. Right, moving on then. Item number 10. We have a break from Alex. It's over to Joe for the administration update.
Thank you,
And hello,
Chair.
Joe.
So the number of members registering for My Pensions Online continues to increase. As of today, we have 15,306 members who have registered, which equates to 23.65% of the fund's total membership. On Wednesday this week, our Chief Information Security Officer and I will be carrying out our annual tabletop exercise with Hayward Pension Technologies, and the results of this exercise will be brought back to the next meeting. As you know, this year's the valuation year. Letters were sent out to all employers on the 11th of November with the valuation results, and employers have until the 23rd of December to come back to the fund if they want to discuss any of their results. We held a hybrid employer valuation meeting on the 23rd of November. 29 people joined the meeting, and that covered 26 of our employers. And then just finally, in June, the Pension Administration audit took place. The auditor provided full assurance, and a copy of the management report is available in Appendix 1 of your papers.
Mic off. Okay, thank you very much, Joe. Just a quick question from me. I mean, are you happy then with where we are at the moment and the progress we've been making in the last quarter?
From the administration side?
Yeah.
Yes, yeah, we're in a very good position. Generally, you know, we've got no backlogs in the administration team. That puts us in a good place now to look at the McLeod project, which will be coming in next year. And we've done lots of work with the valuation and the results, and that's going well as well.
Fine, good. So that the second bit of that would be then looking at the engagement with the employers about the valuation. Are we roughly where you would hope to be as well?
Yes, I think from my perspective, I'm not sure if Alex wants to say something after, but from my perspective, I think we're in a good position. We've had correspondence with a few employers, and some discussions are still ongoing, but I think we are in a good position.
Yeah, I would agree with that. Just to add, I think the employers where we anticipated having discussions, we are doing so, and I think we've also, through Joe's team with the data, been able to sort of expedite some of the process and allow for more opportunity for the engagement, which I think is helping, and I think the employers are appreciative of.
Okay, thanks. Any other members, or indeed board members, any questions or comments about the update and the appendix? David, yeah.
No, just positive to see a very good audit report.
Thank you.
I'll second that. I've been wrangling my own in my day job, which is nowhere near as neatly defined. I'm quite jealous of I'm quite jealous of what you're pulling off. So if nobody else has any questions on that, I guess recommendation on page 104 is that the committee note the report. Everyone happy with that? Raise your hands, please. Excellent. That's 4 out of 4. We can move on. So thank you very much, Joe, although it is you again. So item number 11, we have elected member training.
Thank you, Chair. So pension committee members will be familiar with this report. I just wanted to touch on the National Knowledge Assessment. So I just like to, or Alex and I would just like to thank all pensions committee who participated in the National Knowledge Assessment. 9 members from across the pension board and pension committee participated in the assessment. Last week, the fund received the report from Hymans, and we will be going through the results, and this will be brought back to Pensions Committee at the next meeting. Officers and the chair are aware that since the appointment of the new Pensions Committee, a substantial amount of training has been circulated to members. So we would welcome your thoughts on the training and whether you would like any additional or alternative support.
Okay, thanks for that. Now I've got some thoughts and questions on this, but oh, hang on. I almost left the meeting. I've got some thoughts and questions on this, but do any other members want to raise anything before I kick off? David.
Chair, I think it's only to say I can't really make many suggestions about training. I think, as you referred to earlier, the more you immerse yourself in this, a bit more you start to understand, and it is a bit of a learning curve. That's all I'll acknowledge, and hopefully it's a curve that we're starting to ascend rather than descend.
Yeah, no, I agree on that one. If nobody else wants to raise anything, so basically, I have had some conversations. I've shared these with Alex from a couple of members on the committee about that steep learning curve. I guess the question is whether we've got the balance, the balance of the speed of trying to sort of achieve that upward trajectory. Because I think I've spoken to some members who feel that essentially there's been a bit too much of an overload, especially as we're starting from a position where 5 out of the original 6 and now 4 out of the 5 are all new members to the committee, and I just wonder whether we need to have a conversation about sort of the pace and quantum of information that is given to us in any given sitting. I'll be honest with you. I mean, I'm in a very privileged position that I speak to Alex probably every day, and we catch up most weeks, and I've got the benefit of being able to absorb the information orally as well. If it wasn't for that, I think I'd find some of a lot of the information we're presented with, and indeed some of the training courses, all of which are from external providers, a bit much at times. I wonder whether there is an expectation that there's quite a high level of knowledge and expertise as a minimum, and then throwing people into that, whether that's been a bit daunting. So I don't have a response to that about how we move forward, because obviously there is also the trade-off is that we have more training sessions, dividing the information up into different segments. So I guess it's just an opportunity for members to express a view on this, about whether there is any way we think we can potentially make some of the information or the training a bit more digestible. Or is this where everyone goes quiet and it's just me on the gangplank making the I've got John. Yep. And David.
For someone who's been on the committee for a long time, I was working for the first 5 years. With the amount of training, I found it almost impossible. I'll admit it. It's very intense, very difficult, and if you were working, almost impossible, as all the training is in the daytime, when if you're working, that's when you're in work. And that is why, as someone who's been on this committee such a long time, there's been such a high turnover in membership. We've had people lasting a year and then that's it. And then you're losing their expertise and any training they've had, and you're back to square one. So I don't know what the answer is, but I know what the problems are.
Well, kicking the analysis, analyzing and kicking it around is a good thing. I think David, you had your hand up first, and I'll bring in Carl.
Sorry, yes, Chair. I think yeah, it is challenging, and I would agree with John that if you are working, it can be very difficult to fit that in, and it has felt like quite a lot in a short space of time. I would actually need to point out a point of accuracy, because I think I was at the response for investment training on the 14th of the 11th. I can find my notes in front of me, so I think just to point that one out, I thought, as having been a member of that group, I would have been at the training, and I was. So just that correction, please. And yeah, I think it's one of those things, isn't it? You don't know what you don't know, and we've probably had a level of activity and volatility, as we've referred to, with what's been happening in sort of August, September time, that probably is untypical, and probably has precipitated the need for us to get a bit more information than perhaps might have been the case, and that could have perhaps been taken over a longer period of time. Again, like John, I'm not sure what the solution is, but perhaps we can consider sort of maybe a little bit of consultation with the committee as to when good times for training might be.
Okay, thanks, David. Carl, was your hand up earlier? Yeah.
Yes, Chair, thank you. Just to echo some of the points my colleagues have made, and I know I've made some representations to you that I'm finding it a bit difficult, to be honest. The training is very intense. I'm not the cleverest bloke in the world, but I'm not the dullest either, so I'm mid-range. and I've found it a bit of a struggle, to be honest. There's a lot of information. I think a lot of the people on the training and contributing are longer standing members of pension committees, so they sort of got the confidence of knowing a bit before they start. As people have said, very intense. I'm wondering whether we can break that down into sort of bite-sized chunks in future, rather than a sort of 9 till 4 day, which is, I'm sort of, my attention span is waning by lunchtime, and particularly if you're not sort of really getting it, you tend to switch off. So that, the training in and of itself becomes, defunct by sort of halfway through it, for me personally anyway, because that learning curve I'm finding really difficult. And the thing is, then, if I don't really fully understand what I'm talking about, and I'm sure other members and other committees will feel the same, I'm reluctant then to contribute to the Pensions Committee deliberations, because at the risk of looking a bit...
Well, his computer froze then at the relevant point when he was going back to... I'm sure he wouldn't have referred to himself as anything naughty, but I think we get the point. And if he comes back in, I'll ask him to finish off. Ethan.
Yeah, thank you. I think this really is kind of just proof of the point that I made earlier about governance and the challenge, because this was occurring over time in the in the defined benefit plans, the corporate side. This is why, and they were dealing with consultants, and I would suggest that some of the issue was that the consultants were kind of acting as a cover almost for decision making, and unfortunately those same consultants were pushing these complex products. So there was a lot of governance failures going on in there, and it is a difficult problem. I would suggest that's why you have your advisors here, is to kind of help you navigate through the complexity, and it's ever changing of what you're facing. And as far as solutions, we can certainly help with directing you to content that is available in a more bite-sized way. We can record workshops that we deliver. We can have you access that, on your own time. Maybe you want to think about on the panel having certain kind of champions of certain areas, maybe one of net zero and ESG, one of fixed income, one of equities, so that together you maybe the sum of the parts is greater. I'm just thinking of ways to kind of to get you there, but we're certainly here ready to help. And unfortunately, it's not getting any easier. The challenge is actually getting a lot more demanding.
No, that makes perfect sense. I've got some more thoughts, but I'll take comments from the rest of the group first. Betty.
Yeah, I think we also have a really good opportunity coming up with the strategic asset allocation relook. I mean, I'm really not a big fan of, people hiding behind names and labels and, trying to wow with science. I think it's really important to explain things really clearly and simply so that every person off the street, people far less illustrious than you all could understand it, because it's not that tough if somebody makes an effort. But I think it's a very good opportunity we have to really break it down and explain what the stuff is doing and why it's there, and why we need it, and what some of the risks are and the opportunities, and what the thought behind it was, and ask for questions. So maybe we should try to incorporate a bit more training and background, and up, just get everybody's level of understanding and confidence up in as we do the strategic asset allocation review.
No, I think that makes perfect sense as well. I mean, just the two things I was going to add. I think what struck me, and it kind of ties into your point, Ethan, about the level of knowledge for a trustee or director of any fund. It's very telling. And again, I've not been to that many, but it's very telling when you go to a meeting of the pensions board that you have people there who've either been working in it or have been representatives on that scheme for a very prolonged period of time. And actually, there are some very granular questions being asked there, where it becomes, which puts it in sharp relief, if you like, that you've got a bunch of neophytes on the pension committee who don't know enough to be asking some of those questions in that level of detail. Now, the good thing is that the way in which Alex and Joe present their information, it is generally accessible, and actually think you are doing your best to lead us through it. But I think my question I've got, that I think, and it's not for discussion, we're not going to finish this conversation off today, I think maybe we need to engage over Christmas into the new year, is actually how members take their information, and or what is the best way for members to actually accept and take that information. Because I know in general, having coming onto the committee with 2.5 years of Zoom fatigue as it was, I think some of those, and again, they're not things we put on, so it's no criticism of anyone here, but some of the training sessions we've had, which essentially when you've had people sharing PowerPoints on Zoom and it's all smaller and you can't really understand what's going on, and there's 2 or 3 hours of it, Carl is right. It's prime territory to just wander off and start looking at other tabs on your computer when you shouldn't be. So maybe we should have a conversation about actually what we think the best way of transmitting and having a conversation about that information might be. Because I think another thing we don't really have much of a forum from a training perspective is actually to talk over and deliberate about the training that we've been receiving, and actually to kick around some of the ideas and the issues that are being discussed. Because I think, again, it's the nature of the online of the online world we're in. A lot of it is in transmission as opposed to being a way of taking the information in. So maybe, I don't know if that's helpful, Joe or Alex, maybe it's a case we need to take this offline and actually have a bit of a discussion with members about what we think the best way of training, of meeting our training needs might be in the new year. Because again, just briefly, I did find, and I know Alex, I mean, you didn't mention names. I know, Alex, you said there were members of the board who've been engaged for very many years who found the Hyman's exercise quite difficult. And quite frankly, I mean, I was quite pleased that I got over 50% in some of the sections, but there were others where it was just like, you might as well have been alphabet soup on the screen, which didn't, it brought, and it sort of paid no attention to the fact you had people who might only been reading it for 3 months.
Yes, we're more than welcome to, more than happy to take that offline and look into that. And I agree, we've had comments back from pension board members about the national knowledge assessment, and I think my intention was probably to circulate an email to get your views on it, which we can then feed back to Hyman's, because we want this to be something useful that we can use going forward. So, you know, we want you know, members to get the most out of it. So that is something separate that I am going to be circulating later on.
Oh, excellent. Well, I 100% endorse that. That's fantastic. Okay. Any other questions from members or anybody on the or anyone basically on any of the other points on that paper? He says trying to manipulate windows and not closing things down. In which case, members are people that happy to endorse the recommendation at the bottom of page 116, and that we will that we've noted the training update, and that we'll take up the further things offline with Alex and Joe. So John's a yes, David's yes, Carl's disappeared, but at least there's 3 of us. The meeting is still for it. So thank you very much. Moving on then is item number 11. So this is where we're moving to the exempt section of the meeting. No, item 13 rather. No, we're not. It's item 12 is the date of the next meeting, which is the 13th of March 2023. That's for noting only, if everyone's happy with that. So now I will move on to my next bit of spiel, which is agenda item 13, exclusion of press and public. So to agree the exclusion of the press and public from the meeting, as presentations and meeting papers are not for publication, because in accordance with paragraphs 12 and 14 of Part 4 of Schedule 12A of the Local Government Act 1972, open brackets, as amended by the Access to Information Variation Order Wales 2007, close brackets, it contains information about a particular individual and information relating to the financial and business affairs of particular persons, including the council, and in all the circumstances of the case, the public interest in maintaining the exemptions outweighs the public interest as disclosing the information. I think I got through that easier than I did last time. So are members happy to vote to go to a closed session and to exclude the press and public? Hands up, please. Everyone nodding. David, me, John. Fantastic. That is agreed. I think I'm happy to allow members of the board to stay for the exempt items unless there's any issue you want to raise. Otherwise, Alex? No. In which case, there we go. Welcome everyone to the second part of the meeting. So Gerard, rather, if you could